What is home equity? Well, I'm glad you asked. We're going to answer that question pretty quickly by highlighting three main points, but stick around because we're going to make it practical by sharing the story of one of our past clients, Jesse. Welcome back. My name is Gavin Sessions with Loans Made Simple. If you're curious to learn about anything related to mortgage or home loan financing, you're in the right place. Subscribe to our channel. We post new content each week. If you're ready to get qualified for a home loan or get connected to a great real estate agent, scroll down, find our contact information below, or leave us a comment. We'll be happy to get back in touch with you and respond to your comments ASAP. All right, so as I mentioned, we're going to answer the question, what is home equity, by reviewing three main things. Number one, we're just going to define what it is and how to calculate it. Number two, we're going to tell you how to build home equity. And number three, we're going to explain what you can do with it. All right, let's jump into number one. So home equity is very simply the difference in the market value of the property, the current market value of the property versus what you owe on your mortgage. So let's say your house is currently worth $500,000. And let's say you currently owe $200,000 on your mortgage. Your equity, very simply, is $300,000. So that $300,000 of equity represents the portion of the home and the property that you actually own. Jumping into number two, and I said we were going to get through this pretty quickly. So number two is, how do I build home equity? So building home equity can occur through many different ways. The first way you can build home equity is at the purchase of the property with a down payment. So let's say you buy a house for $500,000. Let's say you put $20,000 down, which means you likely have a loan amount of about $480,000. The difference between that loan amount and the value of the property, that $20,000, is your equity. Let's say the appraiser actually says the home is worth $505,000, and that's relative to other properties that have sold recently in the immediate vicinity. So you have your $20,000 down payment, plus you have $5,000 of additional equity because the appraiser believes the home is worth $505,000. Another way to build equity is by making regular mortgage payments. So again, sticking along the same lines, you buy your house for $500,000, you make a down payment of $20,000. The appraiser says the home is worth $505,000. Fantastic. You're at a $25,000 equity position. But then let's say you make regular mortgage payments for years, right? So every time you make a mortgage payment, part of that payment goes to pay the interest that accrues. And the other part of that payment goes to pay down the principal balance. So each mortgage payment, you're actually reducing your principal balance. So fast forwarding years down the road, if we looked at an amortization schedule, we could see how much of that loan you'd paid off. So as your loan balance shrinks, let's just say it shrunk to $460,000, all of a sudden your equity has grown from $20,000 of a down payment then to $25,000 because the appraiser said it was worth more than you paid for it. And then you've actually paid down $20,000 in principal. So all of a sudden your equity position is now at $45,000. Moving right along. And this is probably one of the more powerful ways that you can build equity. And that's through appreciation of your property. So properties appreciate in a way similar to a savings account through a compounded method. So did you know that since 1991, homes have appreciated on average 4.3% per year? And that's nationwide. So let's make it practical. Let's say you bought a home 7 years ago for $400,000 and it has appreciated on average 4.3% per year. Your home is now worth $537,000. So your minimum equity position in your house is now $137,000. And that doesn't even take into account what your down payment was or the principal that you've paid down over that 7 years. Last but not least, another great way to add equity to your home is by making improvements. So oftentimes people will remodel a kitchen, or they will add a bathroom, or they will add square footage, or they will add a covered patio or something along those lines. All those things will add value to your home, which will also further increase your equity position. So once those improvements are made, the value of your house increases, and then the compounding appreciation takes effect on that. And that simply means your home will appreciate at the similar rate, but on a larger basis, thus growing your equity even faster.
Just want to pause the video for a quick moment and invite you to connect with us. If you're ready to take the next step to get qualified and speak to a mortgage professional, a loan officer, or if you'd like to get connected to a great real estate agent, click the links below.
All right, the third thing we want to talk about is, what can I do with home equity? So home equity, kind of like a savings account, is a valuable financial asset that you can leverage for many different things. All right, so the first thing I want to highlight is your opportunity to be able to refinance to more favorable loan terms. And one thing I want to mention is that does not require that you actually spend any of that equity. So as your equity position grows, your ownership interest in the property grows. We already mentioned that, right? So the more skin you have in the game, the less likely you are to default, which makes you a less risky borrower, right? So that number one would give you the opportunity to get rid of mortgage insurance. So if you bought the house with a small down payment, you likely have mortgage insurance of some sort, whether that's through FHA, whether that's through USDA, whether that's through conventional, but you likely have mortgage insurance, and having a greater equity position would allow you the opportunity to get rid of that mortgage insurance and save on that every single month. Additionally, if the market allows, you could capture a lower interest rate, right? And a lower interest rate has the opportunity or ability to save you substantially on your monthly payment, as well as over the life of your loan for total interest that you spend. All right, so jumping into a few more things that you can do with your equity. And these next few will actually require that you get access to that equity and spend it. So the first would be making home improvements to your house, right? So we talked about that already, that when you make home improvements, you're actually going to increase the value of your home. So oftentimes banks are very happy to lend you money in order to make home improvements because you're actually increasing the value of the home, and thus increasing your equity position and thus making you less of a risky borrower. The next thing you can do with home equity is potentially borrow it to help pay off higher interest debt, right? So home loan debt is often the cheapest debt you can find, right? So interest rates for home loans or home equity loans are often lower than what you're going to find on a credit card or a car payment or a student loan or anything along those lines. So as people's equity position grows, they'll often want to consolidate higher interest debt using their home equity, thus saving themselves money every month. Another thing you might want to do with your home equity is use it to pay for educational expenses, right? So college can be very expensive. If you have a strong equity position, maybe it makes sense to borrow some of that equity to help pay for college expenses or other educational expenses. And then last but not least, and of course, this is not exhaustive, some people like to get access to that equity to set those funds aside for emergency purposes or for a rainy day fund. So as I mentioned, those previous few things all require that you get access to that equity and then spend it. So I think your next question is probably very reasonably, how do I get access to that equity? So as I already mentioned, home equity is your ownership position in the home, right? And as your equity grows, your ownership stake grows. But homes are unlike really any other financial asset that can be liquidated, right? So if you have a few shares of stock, you could sell one of your shares and liquidate that and get the money and move on. Your home, you can't sell a share of your home or a portion of your home. The only way to get access to that equity is to take out a home equity loan. And I don't want to cut us off, but this video is not specifically meant to highlight the different types of home equity loans or how you'd go about getting those. So tune into our next video for that. All right, so we've highlighted 3 things about home equity. Number 1, what it is. Number 2, how do you build it? And number 3, what can you do with it? So let's make it all practical, as it can be a little bit ethereal if we don't tell a story. So let's look at Jesse's story, one of our past clients. So Jesse was a first-time home buyer in 2019, and he largely had no money available for a down payment. So we helped Jesse get qualified for an FHA home loan with some down payment assistance to help cover his down payment and his closing costs. And then Jesse bought a home for $157,000. So long story short, Jesse basically bought that home with nothing out of his own pocket, right? $150,000 purchase price, borrowed just about $157,000. His equity position, generally speaking, was 0. Quick side note, FHA loans currently have mortgage insurance for the life of the loan, right? You're going to pay that up front at 1.75%. That's financed into your loan amount. Then you're going to have a monthly mortgage insurance payment as well. So let's fast forward 2 years. Jesse bought that home in 2019 for $157,000, generally with 0 equity. In about 2 years' time, that home appreciated in value to about $205,000. All of a sudden, Jesse's equity position was just shy of $50,000. And all he did over those previous 2 years was just make his monthly mortgage payment. So now that Jesse has about $50,000 in equity, he could do all sorts of things with that, right? So we talked about getting access to that equity to make home improvements, or to pay off higher interest debt, or to finance education, or to set money aside in reserves or for a rainy day. But instead, Jesse decided to take advantage of his opportunity to refinance to more favorable loan terms. So we moved Jesse out of an FHA loan and a second mortgage into a conventional mortgage with a 20% equity position, meaning Jesse no longer had to pay monthly mortgage insurance. Also, the interest rate market had improved substantially, so we were able to save Jesse about 2% on his interest rate. So all in all, we got rid of his mortgage insurance by refinancing him into a conventional loan. We paid off his second mortgage. We reduced his interest rate by 2%, and we saved his family about $300 per month. And that all was possible because of home equity and its compounding effect as homes appreciate and as you make your regular monthly payment. So long story short, who wouldn't want that? That is the power of equity in action. So when we dig into it, home equity is a pretty simple concept, but it can be a bit ethereal until we apply it to a real life personal story. Hopefully listening to Jesse's story has made this very practical for you and has gotten you excited about home equity as well. So if you have further questions about home equity, or maybe you're ready to get qualified for a home loan, scroll down, find our contact information, and reach out to us, or leave us a comment. We'll be down there getting answers to those comments ASAP. We look forward to hearing from you, and we'll see you on the next video.